All right, let's start with a reality check right out of the gate. Look, most traders lose money because, frankly, they let their egos take over. They desperately want to be the hero, right? They see a price just soaring and instantly try to perfectly call the absolute top. Or they try to catch a falling knife by buying into a massive crash before it's actually over. It's this thrill-seeking approach that completely destroys retail accounts. But professional reversal trading, it isn't about guessing. It's about waiting for undeniable proof. So let's dive into this explainer and look at exactly how the professionals actually do it.
So in today's explainer, here's exactly what we're covering. We'll start with an introduction to the reversal trap, then move to Step 1, higher time frame, Step 2, spotting momentum fatigue, Step 3, the liquidity sweep, Step 4, entry and confirmation, and finally, Step 5, master risk management.
All right, let's jump straight into Section 1, the reversal trap. This right here is the core problem facing everyday retail traders. Look, reversals are incredibly appealing because they offer insane risk-to-reward ratios. But that exact appeal is why emotion-driven entries lead to such brutal losses. You can literally see the divide in the market. The amateur's deepest desire is to instantly buy a crash out of pure ego. They just want to brag that they caught the exact penny a market turned. The professional, on the other hand, has a patient, almost boring demand for structural confirmation, because the pro knows a market can stay irrational far longer than your account can stay solvent. I really want you to burn this quote into your brain. The market doesn't pay you to be a genius. It pays you to be right. So the crucial point here is this massive philosophical shift. Professional trading is not a prediction game. It's a methodical reaction to institutional context, liquidity grabs, and confirmed market shifts. Basically, you are simply reacting to the footprints that big institutional money leaves behind. Moving right along to Step 1, higher time frame. Okay, this is literally the absolute first rule of high probability reversals. Never, ever use just one single time frame to make your trading decision. When you're pairing time frames, if your entry time frame is, say, the 15-minute chart, your higher time frame narrative has to be the 1-hour chart. If you're trading the 4-hour, well, your higher time frame is the daily. By zooming out to this higher time frame narrative, you reveal the major levels of structure. Because, guys, this is where the massive institutional money actually sits, just waiting to be triggered. And that brings us to what we call the optimal trading zone, or OTZ for short. An OTZ is a major supply or demand zone, or maybe a horizontal key level that's been tested multiple times in the past. Now, here is a strict warning for you. Never trade reversals in the middle of nowhere. Seriously, if the price is just floating between major zones, do absolutely nothing. You have to insist on waiting for the price to fully mitigate an optimal trading zone before you even start looking for a trade. Which leads us to Step 2, spotting momentum fatigue. So price finally enters that predetermined optimal trading zone. What now? Well, we need to shift our focus to the specific visual cues that tell us the prevailing trend is actually dying on its feet. Inside your zone, you want to see 3 screaming signs of fatigue. First up, RSI divergence. This is when the price pushes up to a higher high, but your RSI indicator makes a lower high. That shows internal momentum is fading rapidly. Second, candlestick pressure. Look closely at the size of the candles. If they're shrinking rapidly as they hit resistance, buyers are losing their grip. And third, the moving average swoop. If you use the 21, 50, and 200 moving averages, you want to see them start curving or bowing. That means the vertical momentum has completely stalled out. All right, Step 3, the liquidity sweep. This is probably the single most critical yet most frequently missed step in this entire framework. To reverse a market, massive players need a tremendous amount of fuel. So you have to ask yourself, where is the liquidity? Institutions will deliberately push prices just slightly above known resistance levels. Why do they do this? To trigger the stop losses of early sellers and aggressively entice breakout buyers in this massive fakeout. So remember this golden rule. If you can't spot the liquidity, you are the liquidity. As a professional, I demand that you wait for this exact manipulation. You need to see a sharp V-shaped reaction that traps those early impatient traders before you even consider taking a position. That liquidity grab, that is the exact fuel required to send the price violently in the opposite direction. Now for Step 4, entry and confirmation. Okay, so you've confirmed the higher time frame zone, you've seen momentum die out, and you've witnessed that brutal liquidity sweep. Now we finally drop down to your specific entry time frame to build the actionable mechanics of the trade.
To stay completely objective here, we use the CEST framework. That stands for conditions, entry, stop, and target. To fulfill your conditions, you require a market shift. So if the market was making higher highs and higher lows, you must wait for the price to break the last strong low. This structural break is your ultimate confirmation that sellers have officially taken control of the order flow from the buyers.
So what's the actual entry trigger? You are looking for precise structural patterns right at this exact moment. A double top or head and shoulders pattern, those are prime structural triggers. Combine that with a big red engulfing candle, and you've got solid proof of immediate selling pressure. Oh, and here's a professional secret for you. Timing absolutely matters. Reversals have the highest probability of success when they align with the huge volume spikes we see precisely at the London or New York session opens.
Finally, step 5, master risk management. Look, this is the mathematical reality check. This is what separates consistent, wealthy professionals from desperate gamblers. If you skip this, literally everything else we've just discussed is entirely useless. Let's look at where we actually put our money. Contrast the stop loss with the target. Amateurs, they put their stop loss exactly on the high of the structure, where it is incredibly easily hunted and triggered by just a tiny spread widening. Professionals use the average true range, or ATR indicator. You place your stop loss roughly 1 times the ATR above the structure high. That gives your trade the necessary room to breathe through normal market volatility. And for your target, you've got to remain realistic. Aim exactly for the next major level of structure on the chart. And whatever you do, the math just absolutely has to work in your favor. You must have an absolute minimum reward to risk ratio of 2 to 1. Think about it. If you're risking $100, the structure of the chart must realistically allow for a $200 profit. If that 2 to 1 ratio isn't clearly there, you simply walk away from the trade. No exceptions. Over the long run, this mathematical edge is exactly what keeps your account growing, even when you take those inevitable losses. To wrap up this explainer, I want to leave you with one final, very powerful thought. Trading reversals isn't about being smart. It's not about being a genius or feeding your ego by trying to catch a falling knife. It's about being profoundly, methodically patient. You have to wait for the higher timeframe context. Wait for those brutal liquidity sweeps that trap the amateurs. And wait for the structural market shifts that confirm the big institutions are moving. So the real question is, are you disciplined enough to let the market come to you?